Hey everybody, Marty Mazur. Good morning, June 12th, 2017. My schedule this week demands that I come to you a little early with the weekly video. In front of you, you have the candle chart for the Financial Sector Index ETF. XLF is the symbol. I'm showing you once again the retracements that are so important to a lot of technical analysts. Starting at what we'll call the election low back in November, going to the recent high for financials, and then just kind of retracing back. I've eliminated all the lines except the all-important 38.2, 50, and 61.8% retracements. Make no mistake, traders put a great deal of importance on these levels. And as you can see here, after the peak in financials on March 1st of this year, you can see there was quite the precipitous decline that continued to find support right at, ironically, the 38.2% retracement level. So essentially, folks, what was happening, market sold off here, traders jumped in and bought, did some selling, bought, did some selling, bought, did some selling, and so forth. Lately, the last few days, as you can see, we have 5 consecutive days. That's a very good look, and as you can see, we've broken through some resistance here on that particular ETF at $24 a share. Now, that remains to be seen, but I can tell you that we will be having interesting conversations if and when the ETF gets above this level right here, which would be breaking above the recent high. It would be expected to find resistance for a while up against that. So we've got a little bit of blue sky here. You get above that, and we're going to be having a different conversation about the forward outlook for financials. Right now it's choppy, a little bit of hope in here, and as we discussed, there was some real rotation out of technology into financials on Friday. One more look here from a technical perspective. I just want to show you the 50-day moving average. Very important as well. We hear a lot of this in the media, talk about crossovers with the 200 and so forth. Here is the financial sector finding support along its 50-day moving average. Nice big rally up in here, and then just coming right down below that. So folks who were buying it here got burned. As we bounced against that 38% retracement, those folks had an opportunity to get the heck back out of there after they got scared with this big decline. So then we had resistance, 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 resistance. The break above that with some force means the folks who were selling it or shorting it here then got burned, and now we've broken above it. So this could very well be support as these folks jump back in, if indeed they do, if it comes back down and tests that 50-day moving average. Okay, so I talked about the rotation out of technology. I think we should take a look at that. Lots of volatility the last few days. This is that huge decline on Friday. You can see it found support. I showed you an intraday chart over the weekend where it found support there, but today it just kind of picked right back up and sold off. Found support right in here. This is the bottom of the range on this candlestick. But here we are back again to the election low. They came up, consolidated a little bit, and then had a big burst coming out of earnings reporting season, and then topped out in the intraday on Friday, and here we came back. So folks, if you look at these retracements, we have had a really substantial run in technology stocks, and we have yet to begin to retrace that in any meaningful way, and that first level of support would be that 38.2. A lot of traders will wait for a 50% retracement before they come rushing back in, if indeed at all. We break down below the 62%, and then we've got something else to talk about in terms of corrections and bear markets and so on. So right now, technology, even with these 2 big days, Friday and then today selling off measurably, very much within the context of an ongoing bull market. Looking at that 50-day moving average, let's see how telling it might be for technology. Here we are coming all the way back to the Brexit low, breaking through that, and then it being support for quite some time, resistance for a number of days or weeks, and so forth. So struggling with that 50-day, but pretty much since then, if it touched it, it was big support. And here we are today, ironically, touching on that 50-day moving average. So, and you can see technicians bought technology stocks right against that this morning. So I don't know that that's going to hold. I don't know that it's going to break down and break below and test these levels here. Of course, that remains to be seen. But it's always fascinating to take a look at the action and volume and so forth like we did last week as the market reaches certain levels. So right now, Either the 50-day moving average is going to be support and we're going to continue and possibly break through this old high, or it's going to come down and there's going to be a longer period of consolidation, or indeed is the beginning of something more pernicious, which will show up in other indicators as we move along. Being long-term investors, we don't react to volatility like this, but right now the longer-term moving averages, the 50 again, that would be shorter term, but the 100 and 200 day show the sector very much moving in a long-term uptrend, and until some of these indicators begin to break down, we're going to continue business as usual. Lastly, I wanted to show you again 2013. There were some eerie similarities leading into this year compared to 2013. Here we are in a period, same time of year we are right now, with a large 7.5% drawdown. Of course, we found out that that was in the context, again, of an ongoing bull market, and we had a whopping 29% gain in the S&P in 2013. Did our moving averages, the 50, 100, and 200, tell us to do anything other than stay the course in 2013 amid all these drawdowns? No, they did not, thank goodness, because if we would have reacted to some of these drawdowns, we would have missed out on a really nice gain. This is not a guarantee that things are not going to break down, and we won't be having different conversations about downward sloping trends and changing in tactics and allocations and so forth going forward. It's just that right now, probability suggests that all this is happening within the context of an ongoing bull market, and for today, it's volatility to ignore. Of course, I'll keep you updated each week. Thank you as always for watching and listening. Have a great rest of the day. Take care.